He is George Soros, a recognized successful investor through his hedge fund, the Quantum Fund. He was George Soros's right-hand man, co-founding the Quantum Fund and serving as its lead analyst for 10 years, achieving an impressive return of almost 3,400%. This represents an annualized return of over 42%, while the cumulative return of the S&P 500 in the same period was 47%, nearly equivalent to the Quantum Fund's return in a single year. The success was such that in 1980, at just 37 years old, Jim Rogers decided to retire from the world of professional investment. Born in 1942 in Baltimore, Maryland, he grew up in a small, remote town in Alabama. There, his father managed a small factory for the Borden Chemical Group, but the salary was modest. Perhaps precisely because of this, when he was just 5 years old, Jim already showed great entrepreneurial intuition. He started 2 businesses, first selling peanuts and then collecting empty bottles left by fans at the baseball stadium. Every dollar counted. But, of course, Jim was ambitious and wanted much more. So, when the time came, and despite being a student from a remote and obscure locality in Alabama, Jim achieved something that no one thought was possible, a scholarship to the prestigious Yale University. Later, he crossed the pond to study politics, philosophy, and economics at the University of Oxford. After studying at Oxford, Rogers had 2 clear realizations. First, that he wanted to pursue a career in finance, and second, that analyzing companies and businesses was much more stimulating for him than trading. However, as often happens, his first contact with the markets was not exactly a success. It was in 1966 when Rogers was working at the financial firm Dominick & Dominick when one day he suggested to his superiors that he might leave his job to pursue an MBA. Do you know what his boss replied? "Don't be ridiculous. Short sell, and you'll learn more from a single transaction than you will in 2 years at business school." Rogers followed his boss's advice and began short selling some companies he believed were overvalued. However, prices continued to rise for 2 years, and Jim lost all his money. He later said that this was one of the best lessons of his life, teaching him 2 very important things. First, that he needed to know all the details before making an investment, and second, that it was essential to avoid permanent capital losses. Buying cheaply, with a strong margin of safety, is indispensable. It was in the late 1970s when Jim Rogers met George Soros, a colleague at Arnhold and S. Bleichroder. As neither of them wanted to be employees of anyone and they both wanted to succeed in the world of finance, they decided to open their own investment fund in 1973, later known as the Quantum Fund. Soros would be the trader, and Rogers the analyst. Among their most successful investments, we can find operations such as the purchase in 1974 of large blocks of shares in the military armament company Lockheed, which was not doing well at the time. Rogers realized a crucial detail following the 1973 war between Israel and the Arab countries. Thanks to electronic equipment supplied by the Soviet Union, the Egyptian aviation had been more efficient than expected. Seeking more information, Rogers traveled to Washington, where he made an important discovery. The Vietnam War had consumed so many resources that American equipment had fallen behind the new Soviet equipment. The situation was such that even the Pentagon's pigeons felt the urgency to spend a lot of money renewing their military equipment. And that's precisely where Lockheed comes in, a company in which the Quantum Fund became its largest external investor. Do you know what happened? In a few years, the stock rose from $2 to $120. One of Rogers' favorite investments involves discovering companies that have struggled or even been on the brink of bankruptcy but that he believes can recover. On the other hand, another of his great passions is shorting overvalued companies. This was, for example, the case with the cosmetics company Avon. You see, Rogers had detected a change in the makeup consumption pattern. As fashion trends shifted, its usage was declining. So, after thoroughly analyzing this company, he understood that it was absurd to pay 70 times its earnings, which was its P/E ratio at the time. Thus, he short-sold at $135 per share. The following year, Avon's shares plummeted by 80%. Rogers argues that when structural changes are occurring in troubled markets, most companies will benefit from it as long as they meet certain minimum valuation criteria. For example, in 1984, he decided to invest in Portugal. The Lisbon Stock Exchange had been closed to foreigners for quite some time, and when that changed, Rogers saw a clear opportunity. Portugal was opening up to the world. It was time for takeoff. He ended up investing in 35 Portuguese companies. At just 37 years old, Jim Rogers was a millionaire and had the rest of his life to travel and manage his own wealth. Over the following years, he dedicated himself to traveling, including 2 complete around-the-world trips.